If you're a business owner in Canada, you've probably been busy focused on building your company. You haven't had time to think seriously about how you'll exit. And when you finally ask for advice, what do you hear? Just sell the business. Use the Lifetime Capital Gains Exemption. Max out your RRSP and invest the rest. But that's surface level. Because the truth is, retirement for business owners is different. You don't have a company pension. You don't get a gold watch and a guaranteed monthly income. What you have is a complex, valuable asset, one that needs to be handled strategically. And here's the problem. Most advisors treat business owners like salaried employees. They don't ask, how are your retained earnings invested inside the corporation? How could you draw income from the business after you step away? Is your business structured to minimize tax, not just at sale, but for your retirement income? And what happens to all of it when you pass? If you've spent decades growing your business, you deserve a retirement plan that actually understands the complexities of being an owner, not just an employee. That's what we're going to cover today. Hi, I'm Darcy Bell, Certified Financial Planner Professional with IG Wealth Management. I help Canadians grow, protect, and optimize their wealth, especially during retirement. And for Canadian business owners, retirement planning often falls through the cracks because you're busy running the company, you're reinvesting, and you're told, don't worry, you'll figure it out when you sell. But waiting until the end can cost you in taxes, missed opportunities, and reduced control over your financial future. So in this video, we're going to break down what most retirement advice misses when it comes to business owners, how to structure your exit to protect your wealth, and how to convert the value of your business into flexible, reliable retirement income. Before we get started, please be sure to like the video. Leave a comment if you're planning to exit your business in the next 5 to 10 years, and subscribe for more real retirement strategies for Canadians. Let's dive into part 1, why business owners need a different retirement plan. Most retirement advice in Canada is built for employees. It's based on contributing to an RSP, building up a TFSA, paying off your mortgage, and then turning your portfolio into monthly income at 65. That's fine if you've been working for a salary and contributing to a group RSP or pension for the last 30 years. But business owners don't have that structure. You have complexity. You have income that fluctuates. You might have retained earnings inside your corporation. You may not have contributed much to an RSP because you are reinvesting in the business instead. And you probably have no guaranteed pension, no structured retirement plan. Just one big question. How do I turn the value of my business into personal retirement income? Here's the thing. You don't need to follow the same path as everyone else, but you do need a plan that reflects how business owners actually build and preserve wealth. That means thinking differently about tax efficiency. Not just now, but over the next 10, 20, even 30 years. Corporate structures like holding companies, share freezes, and capital gains exemptions. Income smoothing, drawing from the corporation without triggering unnecessary tax. Succession or sale strategies. And what to do if you don't want to sell at all. This is where most advisors fall short. They don't understand how to integrate your business into your retirement plan. They look at your RSP and ignore your corporation. They plan as if you're already retired, not someone who still controls significant assets inside a private company. So if you're a business owner, you need a retirement plan that starts before the sale. One that's built around how you exit and how you'll be taxed and how you'll generate income without giving away more than necessary to the CRA. In the next part, I'll walk you through a few real-world scenarios where business owners are using different strategies to exit smart, draw tax-efficient income, and maintain control of their wealth after they step away. Part 2, real retirement strategies for business owners. Let's look at a few smart ways Canadian business owners are retiring. not just by selling the business and walking away, but by planning intentionally for income, control, and tax efficiency. Because if you're still holding significant value in your corporation, you need to think beyond the sale price. Scenario 1, drawing income without selling the business. Not every business owner wants to sell. Some prefer to step back gradually, hire a general manager, and continue owning the business while reducing their day-to-day involvement. Here's where most advisors go wrong. They assume retirement only starts once you liquidate. But in this case, you can stay on as a passive shareholder, draw dividends from your corporation, or even set up a holding company to accumulate and invest retained earnings tax efficiently. You're not working anymore, but the business is. And that means you're still generating income, just without the pressure. It's a great solution for owners who want flexibility and don't need a lump sum payout right away. Scenario 2, selling the business and using the Lifetime Capital Gains Exemption. Let's say you want to sell, maybe to a competitor, or maybe to a younger family member or key employee. If the company qualifies as a QSBC or Qualified Small Business Corporation, you can use the Lifetime Capital Gains Exemption to shelter up to $1.25 million of gains from tax as of 2025. This could save you over $250,000 in taxes if planned properly. But timing matters. If you've got too much passive income inside the business or too many non-business assets, you could disqualify yourself without knowing it. That's why pre-sale planning is critical. You might need to purify the corporation well in advance. And you'll want to structure the sale to keep your exemption intact. Scenario 3, using a holding company for retirement income and estate planning. Many business owners don't realize how powerful a holding company can be in retirement. You can transfer retained earnings to the holding company through a tax-free intercorporate dividend. Invest those funds in a diversified portfolio. Pay yourself eligible dividends in retirement, and even layer in corporate-owned life insurance to reduce tax and pass on wealth efficiently. This allows you to create an income stream that isn't tied to employment, and it gives you control over how and when you draw funds. It also separates business risks from your retirement capital, which can be a smart move if your operating company is exposed to liabilities. These are just a few strategies that successful business owners are using today. The key takeaway? Your business isn't just something to sell. It's something to plan around years before you retire. Because the better your exit strategy, the more freedom and security you'll have in the next chapter. In the next part, I'll walk you through the common mistakes business owners make when planning for retirement and how to avoid them. Part 3, common mistakes business owners make when retiring. Even the most successful business owners can make avoidable and expensive mistakes when planning for retirement. Here are 4 of the most common pitfalls I see and how to avoid them. Mistake number 1, waiting too long to plan an exit. A lot of owners put off retirement planning until they're ready to leave. That usually means they haven't structured their business to maximize value, explored their capital gains exemption, or figured out how they'll generate income after the sale. If you wait too long, you may be forced to accept less than what your business is really worth, or trigger tax consequences that could have been avoided with a little preparation. The best time to start planning? 3 to 5 years before you exit. That gives you time to clean up the books, restructure shares, purify the company if needed, and put a tax-smart withdrawal plan in place. Mistake number 2, over-relying on the sale of the business. Some owners assume they'll sell a business and that a lump sum will fund their entire retirement. But here's the risk. What if you can't find a buyer? What if the market conditions change? What if the value of the business isn't as high as you expected? Building up personal assets outside the corporation through dividends, holding companies, or even a TFSA gives you options. It also means that retirement doesn't depend entirely on one big transaction. Mistake number 3, ignoring the corporation after retirement. Many owners stop working but keep the corporation open with significant retained earnings still inside. But they don't have a plan for how to draw income tax efficiently, what to do with the corporate investments, or how the corporation fits into their estate plan. If you're not actively managing how money flows out of your corporation in retirement, you could be facing higher taxes, double taxation at death, or missed income opportunities. A plan for your corporation after retirement is just as important as what you do before the exit. Mistake number 4, missing the chance to use insurance strategically. Business owners often overlook how corporate-owned life insurance can reduce tax and enhance their estate plan. It's not about sales tactics, it's about numbers. When structured properly, permanent insurance inside a holding company can grow capital tax-sheltered, pay out tax-free to your beneficiaries, and reduce the tax burden on retained earnings when the second spouse passes. It's one of the most efficient ways to transfer wealth from your business to your family or your estate. These mistakes aren't about poor judgment, they're usually just the result of incomplete advice. Because most advisors don't specialize in retirement planning for business owners. But if you know what to watch for and build a plan in advance, you can avoid these pitfalls and set yourself up for a retirement that's flexible, tax efficient, and fully under your control. In the final section, I'll show you exactly what steps you should take next and how to start creating your own business owner retirement plan. Part 4, what you should do next. So if you're a business owner in Canada and you're thinking about retirement, here's the most important thing to remember. You're not just exiting a business, you're unlocking your life's work. And how you handle that transition will shape your financial freedom, your tax position, and your family's future for decades to come. That's why your retirement plan needs to be more than just sell the company and invest the money. It needs to account for how and when to sell, or whether to keep the company, how to draw income from retained earnings in a tax-efficient way, whether to use a holding company to separate assets and reduce risk, how to integrate your business into your estate and legacy plans, and how to make sure the CRA doesn't take more than they need. Because your corporation isn't just an operating entity, it's a retirement engine. And with the right planning, it can continue working for you long after you've stepped away. What you should do next. If you're planning to retire in the next 3 to 10 years, this is the perfect time to start building your exit and retirement income strategy. And if you've already retired but still have value locked up inside your corporation, there are still ways to unlock it efficiently. That's where I come in. If you want to create a personalized retirement plan as a business owner, click the link in the description to book a free, no obligation consultation with me. We'll look at your business structure, your corporate and personal assets, your retirement income goals, and how to transition from business owner to financially free retiree without giving half of it to the government. It's not about guessing, it's about strategy, structure, and smart timing. Let's build a retirement plan that reflects everything you've built and sets you up for the next chapter with confidence and clarity. Thanks so much for watching. If this video was helpful, give it a like, leave a comment if you're a business owner planning your exit, and subscribe for more Canadian retirement planning strategies.